In this video, we'll continue our discussion on terminal value. We will work on how to calculate terminal value. Before this, let's recap what we have done so far in terminal value. If you remember, we discussed that while we forecast dividends, it becomes difficult to forecast after a certain year. The assumption comes that the company is stable enough to grow at a constant and steady rate after that. At that point, we apply Gordon growth model, which is nothing but dividend in the said year multiplied by 1 plus g and divide by r minus g, where g is the terminal growth rate, which is the rate at which dividend is going to grow till perpetuity. It is to be taken care that it only works when your r is greater than g. Let's solve one example. In this example, stock XYZ paid a dividend of $3 for financial year 2011. Its investors' required rate of return is 10% on equity dividends, and dividends are expected to grow at 7% in perpetuity. Calculate the value of stock. So, we have D0 as $3 and cost or return on equity as 10%. The perpetual dividend growth rate is 7%, which means this is terminal growth rate. So, we'll multiply the current dividend by 1 plus the growth rate. This will give us the dividend for next year, which is D1. To calculate the terminal value, we will divide this by R, or sometimes called Q minus G. We have cost as 10%. So, we have D1 divided by R minus G. $107 is the stock value. This is an important concept, and this concept is used extensively at many places. We will see this at several places. This concept will be used during DCF method too, in multi-period DDM, or during DCF, if we are in 9th year. Then we will calculate D9 multiplied by 1 plus G and divide by R minus G. This ends this chapter of growth and terminal value. See you in the next chapter of free cash flow. Take care, and don't forget to subscribe, like and share the videos.